All right, so on to some news. First, talking about doing my room up here, the crypto cave and all that. I told y'all eight eight ninety nine. Yeah, $899. Let me just show you because I wasn't kidding. This is a steal as far as I'm concerned. Look at this. All right, so there's right behind that couch or love seat, whatever you want to call it. It's called a couch. Directly behind there, where that wall is going to be a wall going all the way across where that garage door is, about a foot or so, foot and a half this way, where that beam is up there, in between the light and that other beam. So picture this: you got these two right there. Right next to it are going to be two. They'll probably be closer to each other. This is the recliner I told you about separately. Those salt bags will be gone. That AC unit will be gone. And I was thinking that will kind of go over there where that little white thing is behind there. $899. Yeah, I'm sure it's probably made in China. Okay, let me just say that. But I'll take it. You know what I mean? Can't believe that. That's a $2,000 something set right there. Oh, guaranteed anywhere else. I mean, I was looking for stuff like that. So I'm psyched. Ready to do some damn night searching. Have some peeps over, a little C-SETI action over at Jason Ip4's Crypto Ranch in the Crypto Cave. Doing some live streaming, whatever the hell we're doing, hanging out. But anyways, an accountant smells a rat in our global credit bubble. This is from Wolf Street. Actually posted by Peter Dagmeyer of Sprout Money, Canada. 20 years ago, Doug Nolan was so worried about imbalances surrounding the dot-com boom that he began to title his weekly reports The Credit Bubble Bulletin. Years later, he warned the world about the impending 2008 crisis. However, a coming implosion, he said, could be the biggest yet. Quote, "We are in a financial bubble, which I call the granddaddy of all bubbles," said Nolan. "Economists can't see it. They can't model money and credit. However, to those outside the system, the facts are increasingly clear." Nolan points to inflating real estate, bond and equity prices as key causes for concern. According to the Federal Reserve September Z1 flows of funds report, the value of U.S. equities jumped $1.5 trillion during the second quarter to $42.2 trillion, a record 219% of GDP. Nolan's credit bubble thesis. Nolan may be right. A report by the International Institute of Finance released in June estimated that global government, business, and personal debts totaled $217 trillion earlier this year. That's more than 3 times, 327%, higher than global economic output. Adding to the complexity is the fact that not all debts are fully recorded. For example, according to the World Economic Forum study, the world's 6 largest pension saving systems, the United States, the UK, Japan, Netherlands, Canada, and Australia, are expected to experience a $224 trillion funding shortfall by the year 2050, which I discussed the other day. Nolan's warnings come true during a time of exceptional public trust in governments. Once again, Martin Armstrong, that trust in government begins to fail this year and continue on for many years. As I've mentioned about 3 times now recently. That was from his economic confidence model. Anyways, Nolan's warning come during a time of exceptional public trust in government, central banks, regulators, and other institutions, right? Not for long. Market volatility is trending at near record lows. In June, Federal Reserve Chair Janet Yellen spoke for many when she said that she did not see a financial crisis occurring, quote unquote, in our lifetimes. Unburdened by economics groupthink. Oh, no. Unburdened by econometrics groupthink. So why would Nolan, who during his day job runs a tactical short book at McAlvany Wealth Management, see things that government, academic, and central bank economists don't see? One possibility is because Nolan, who studied accounting and finance in college and began his career as a CPA at Price Waterhouse, is not an economist. He is thus not burdened with the dismal sciences limitations. Although Nolan eventually completed an MBA and some doctoral studies, he was never forced to buy into the econometrics, if you will, groupthink that plagues the profession. Nolan is thus free to incorporate historical, financial, geographical, and other data into his analysis. Another possible reason is that Nolan, unlike almost all professional economists who missed both major market implosions and recessions of the last 2 decades, doesn't hide it when he makes a bad call. Stepping away from the pack. Indeed, the Credit Bubble Bulletin website hosts issues dating back to the late 1990s. This policy of tracking how previous forecasts play out over time enables Nolan to learn from previous prescient calls, but also from ill-timed projections or mistakes. It has also spawned a consistently constructed narrative that identifies credit growth as the key metric surrounding systemic instabilities, which strengthened over time. Nolan's ability to step away from the pack is far from unique. Indeed, almost all of the loudest and most eloquent warnings related to the global financial system come from non-economists. Jim Rickards, author of The Road to Ruin, as you know, he's hosting that event in Australia in November. Author of The Road to Ruin, The New Case for Gold and Currency Wars, also got his initial training as an accountant. Ian Gordon and Nell Ferguson both studied history. Both Prechter, founder of Elliott Wave International, studied psychology. Not both, what did I say both? Robert Prechter, founder of Elliott Wave International, studied psychology. Nassim Taleb, author of The Black Swan and Anti-Fragile, did his PhD thesis on the mathematics of derivatives pricing. A $10 trillion Fed balance sheet. Military confrontation, question mark? Next title of this piece. So how will this all play out? Nolan believes that markets will eventually seize up, as in 2008. Interest rates will then rise sharply as the much ridiculed bond vigilantes finally appear on the scene. The practical effect will be that the Federal Reserve's balance sheet, far from shrinking, as is currently projected, could actually expand to as high as $10 trillion, not $4.5 trillion and then unwind. No, $10 trillion and possibly more. Nolan's track record in this respect is impressive, by the way. The last time the Fed talked about unwinding its balance sheet, back in 2011, he inked a column titled "No Exit," which predicted that the policy would fail. It did, an article which remains on his website to this day. The inevitable unwinding of the global credit bubble, whether done through inflation or debt write-offs, could create considerable misery, the kind of which most Americans living today have never seen. Nolan fears that in a worst-case scenario, this could lead to war. Funny enough, we've got a couple targets, especially one called North Korea, just ready to go on standby. As I always say, isn't it incredible that there is an enemy, for whatever reason we need one, right there, ready to go. Just, oh, goodness, that came out of nowhere. We didn't see this. We didn't know what was happening. And then there it is. So how will this play out? The practical effect. Well, first of all, get back to where I was. The inevitable unwinding of the global credit bubble, whether done through inflation or debt write-offs, could create considerable misery, the kind of which most Americans living today have never seen. Nolan fears that in a worst-case scenario, this could lead to war, as politicians seek to distract the public from their massive, I'm adding the word massive, oversight failures. Few constraints on credit growth, next and last section. It all comes down to the massive explosion in system credit, says Nolan, who has expanded far beyond the traditional fractional reserve system to include repos, reverse repos, government-sponsored entities, and other shadow banking system products. Back in the old days, you had some constraints on the amount of credit in the system, Nolan says. However, many of these institutions now have the ability to create literally unlimited leverage. Whether the ex-accountant will prove right is an open question. However, if Nolan does turn out to have bungled his call, we will at least be able to study where he made his mistakes by reading those old Credit Bubble Bulletin back issues. by Peter Dickmeyer, Canada, for Sprott Money. People mistakenly believe their pension plans, mutual funds, and other investments are safeguarded. Read, investors are being swindled. Canadian accountants slammed, which is another article from Wall Street. So yeah, we have a debt problem. We are a druggie, and our drug of choice, not you and me, but the government, which by force gives it to us anyways, is debt. It's the way the system works. It was designed to work that way. There's no other solution that the government has and the central bankers have. It is only debt. They can only create debt. And then it implodes at some point, and it is spectacular in a bad way. And then it starts over again. And there are unbelievable business opportunities, purchasing opportunities of things that would make your mind run wild with imagination, which is why it's so critical to enable yourself to have some freaking cash on the side when this all goes down. Like I've said numerous times, you are going to find the best fire sale deals you've ever seen in your life. You're going to go to Craigslist. We were thinking about getting one of those side-by-sides. Yeah, I was looking at a four-wheeler. I was looking at a boat. You're going to find the most incredible deals if you want that stuff. Now, you might be saying, that's cool and all, but I'd rather look at some really cheap, distressed property. Maybe even commercial property. That's where I'd like to go, Jay Snip. And I'd say, excellent move. But it requires you not getting into debt to make the move. Because around that same time, that's when interest rates aren't going to be pretty. They're going to be higher. And you don't want to go get a loan or mortgage or something on something that you should be able to pay cash for and then rent it out, building space, whatever it is, or live in it, whatever it may be. Capitalize on the fire sale, so to speak. That's why we want to do very well with these cryptocurrencies. I'm trying my hardest myself, trying to take all y'all with me, getting into the same ones I'm talking about, getting into, etc. And that's it. But we'll see how it goes. I couldn't argue with what this guy said. I couldn't argue with anything he said. He's right. But are they going to continue printing, continue expanding the balance sheet? 2 years turns into 3 years, turns into 4 years, turns into 5 years. Hey, where the hell's that crash coming? Right. The bottom line is you can't argue with me or anyone at this point and say that stuff doesn't have to be dealt with because it's there, the debt's there, and it's compiling and getting higher and higher and higher, and interest owed is going to get higher and higher. Right. There's going to be a point when just making the debt payment can't happen anymore. Right. So we all are in agreement that it has to be dealt with. The hard problem is when. If this was a normal world, it would have already happened again by now. But it's not. But that doesn't mean, well, in that case, I'm not going to prepare for it. The hell with that. Oh, no. I think it's a real good idea to prepare for it. Precious metals and get some cryptos. Again, cryptos right now is where all the money and action's happening. So do what you will. Take care.